Hey, it's Mark from Union Home Mortgage. I just want to touch base with you real quick. If you're buying a house in Michigan, property taxes are going to be vitally important for you to know what they are when you close and also the following year after you close. So I'm going to take you into a little bit of a deep dive, but this is very important that you understand how Michigan property taxes work. So with properties in Michigan, there's two valuations. There's the state equalized value and the taxable value. Properties are based on the actual property taxes themselves are based on the local millage rates and apply to the taxable value. Those millage rates will vary with depending on what city and or school district that you're in. So you can be in this. So let's say the city of Southfield's got 3 different school districts. You can be in Southfield, but your taxes will change depending on what school district you're in. So it's important to know that distinction. So the state equalized value, when a house is first built, they set this at half of the sale price, and then it'll move every year depending on what the inflation rate for housing, what the housing market looks like. Now there's no so any annual increase or decrease is based on the percent change in the municipality where the property is located, not on the actual parcel. And they do a 2-year rolling average on this. So the taxable value is also on new construction. They base that on half of the sale price. So the SEV, the state equalized value, and the taxable value are the same at the beginning. So any future, so unlike the state equalized value, future increases in taxable value are actually capped to the lesser of 5% or the rate of inflation, whichever is less. Now, when a property is sold or transferred, the taxable value is uncapped and then raised all the way up to equal to the SEV and recapped. And that happens the year after you purchase the home. It's very important that you understand that and that you have a pretty good idea what those taxes are going to look like next year. So homestead versus non-homestead taxes. When a home is used as a primary residence, homestead millage rates will apply. When a house is a vacation or a investment property, non-homestead millage rates will apply. Typically, in almost all cities and townships in Michigan, the homestead rates are lower, so that your property taxes are cheaper if it's actually your primary. It's also important to know that when you're looking at data, especially online, if you're looking at taxes, you need to know whether the house is currently homesteaded or non-homesteaded. That'll give you an idea of how taxes will move going forward. So as a buyer, what does this really mean for you? So I did an illustration. This is an actual house that I pulled the data from. So this house was built in 2006 for $320,220, and the initial SEV and taxable value was $161,110. So it was half of the sale price. So this house sold in 2024, a couple years ago, for $506,000. So at that time, the SEV was $218,850, but the taxable value was only $150,540. And again, this is because the taxable value can only go up 5% of the rate of inflation, whichever is less. So it's capped on the way up. There is no cap on the way down. Now, at the point that it's sold in 2024, the monthly property taxes were $447 a month. So remember that number, $447 a month. And then this house, at the actual assessment last year, so the SEV went to $235,720. The taxable value was uncapped and was increased to equal the SEV and is now recapped. And those monthly taxes now go to $707 a month. That's an increase of $260 a month in property taxes the year after you purchase the home. So it's important that you understand that your taxes, for all intents and purposes, are going to go up. Now, the longer the current seller has owned the home, the wider the gap between the SEV and the taxable value, and the more that those taxes are going to jump the following year after you purchase the home. So before putting your offer in, call the city or township or ask your lender to do this to determine what your future property taxes may look like. They probably won't be much help because they don't want to give you a number, but sometimes they'll let you know what they think they would be based on this year. Before putting in your offer, call your loan officer and have him or her run the numbers so that you know what your payment, cash investment, and future payment will look like. I can't stress enough that you need to know what that future payment looks like. If I told you that your property taxes are going to jump $500 a month and you can't afford an increase of $500 a month, you shouldn't be offering to buy that house. And finally, ask your lender for a personalized buyer report to determine what options may work best for you. My buyer's report will actually lay out what it's going to look like when you close on the property this year and what it's going to look like after they reassess your taxes for next year. So if you've got any questions at all, reach out to me, 248-705-8431. I've been a mortgage lender for 33 years. I believe that confident buyers create successful homeowners, and clarity is the key to being a confident buyer. Give me a shout. Talk to you later.